In this problem, we are going to focus on taking a traditional income statement, as you learned in your prior course, and converting it to a contribution format income statement, which we'll be using for future chapters as well, as this is the core of the course. In a traditional income statement, as you may recall, you would take your sales minus your cost of goods sold, subtract off all your selling and administrative expenses to arrive at net operating income. This was referred to as just net income in a previous course, but this focus is basically on operations, not the financing or investing activities related to a firm, just the operating side. So that'll get us a long way through looking at this course. So let's go with what the information given to us is. We have Marwick Piano Company. They are a retailer, and therefore they purchase pianos at a cost of $2,450 each, and they mark them up and sell them for $3,125. They've given us information about the costs incurred by the company, and this is for a particular month. And they are asking us to prepare an income statement for August, so only 1 month at this point in time. Okay, they want us to organize it by cost function, so we're going to keep this traditional format income statement and putting the cost function as the selling expenses all together and the admin all together. All right, so what we want to do is we want to start with computing our sales number. And you can tell that I've already done this for you, but I just want to explain how I do this in Excel. I would put the equal sign in here, take my $3,125, use the asterisk for my multiplication symbol, times 40 units or pianos as given to us that were sold and delivered to customers in the month of August. Okay. Now, typically I would have on here for the month of August to put a header. This would be Marwick Piano Company, but those would be requirements of a formal income statement. We're going to just do a rough one here to get you through. Now the cost of goods sold, again, remember they've given us this, $2,450 each, and I went along and did the same thing. I took my equal sign to tell it to do the math for me, 2,450 asterisk for the time symbol times 40 pianos. Now, gross margin, hopefully you remember, is a subtraction where you take sales minus your cost to determine the gross margin. Now, hopefully in your mind you understand that this gross margin is actually the markup on the cost to get to my selling price. All right, our next step is going to be to take the cost information and to move it into the income statement format. Now remember, we are only doing expenses for the month of August, so where it says per month, it's really going to be just the $700 for the advertising because it's only 1 month. Now, they want us to compute sales salaries and commissions, so I need to add both of them together. So salaries to me is going to come across as a flat rate of $950, and in your head you should be thinking that it's a fixed cost. But in addition to the $950, we have to take 8% of sales. Okay, our sales was the $125,000 that we saw up above. Okay, so that's typically the math that we're going to do, and I'm going to put it into Excel. So I want to tell it, okay, with the beginning equal sign, that I need to do a computation. I'm actually going to do it in reverse order. I'm going to point to the 125,000. I'm going to multiply it by my 0.08 for the 8%. I'm going to put parentheses around it because of the order of operations. And then to that amount, I want to add the $950 for the sales salaries for the current month. And I come up with $10,950. The delivery expenses are $30, and notice the word per piano sold, which indicates that this is a variable cost. It changes or varies based on the number of pianos sold. So again, the equal sign tells me to do the math. It's $30 per piano. We sold 40 pianos. So I'm looking for $1,200. Utilities expenses are going to be a flat $350 per month. Okay, does it come out to $350 every month? Probably not, but this is what we would expect, a contract rate, a fixed amount. Again, the word per month triggering fixed in your mind. Depreciation is going to be on our sales facility, so it could include the computers, the office furniture, and the part of the building space occupied by the sales department. So that would be the building. Again, it's per month, indicating it's a fixed cost, so I will put 800 in there. Excel has a feature called the auto sum. So I'm going to select it, and it gave me a range that it thinks I want to add, and it is actually the values that I want to add. So I'm going to hit that enter, and it did the math for me. If I needed to change that range, I could have stretched or moved that highlighted box. Okay, just proceeding a little bit forward so I can move on. We're going to go through and do the same thing with our executive salaries. Hopefully, I won't have to explain as much. Okay, again, this time, it tells us it's $2,500. Salaries is typically a fixed amount. Okay, commissions tend to vary with the quantity or dollar value of sales. Insurance given to us as $400 per month. And again, I'm getting these values from the table cost formula given to us in the problem. Now, the clerical costs actually do have some fixed as well as variable portion. So like we did before, I want to do the calculation on the variable first. There's my $20 times my 40 pianos, so that would be 800, plus I want to add the $1,000. So hopefully it come out to 1,800. Depreciation, again, flat. I hit the auto sum feature, and it's doing an intuitive thing, thinking that I want to, and I do want to do that. Okay, now I could take this and actually stretch it up if I wanted to, but of course I don't in this case. Now, what I'm looking for next, okay, is that I want to add my total selling and my admin. So I'm going to do that by putting the equal sign there, selecting my total selling, and then I want to put a plus sign to tell it to also add my admin. Gives me the total net income. I'm sorry, not net income yet, but total selling and admin. That's what I actually added. 14 plus 5 is 19,000. I am working my way to calculating net income, and notice that I abbreviated it as NOI, and I put a check figure there, 8,000. In order to calculate net operating income, remember this is an income statement. I'm going to take my gross margin, which is already, the markup that we calculated, and I'm going to subtract this 19,000 total selling and admin. And I got my 8,000, which was what I was anticipating. Now, we're going to take that same income statement, we're going to format it in a contribution format, okay, which is step 2, with costs organized by the way they behave. Are they variable or are they fixed expenses? So we need to create another category called fixed expenses. And we list them here, okay. Ideally, our net income is going to come out the same. It should come out the same. We have the same costs, we have the same sales, so net income should be the same in this case. All right? We're just going to go through and we're going to identify these costs and consider whether they're variable or whether they're fixed. I'm going to come back to the cost of goods sold. Our cost of goods sold, remember, we're a retailer. Retailer buys and resells the stuff. They do not manufacture them. As a result, that cost is entirely variable in this case. Not all of your problems will be the same, but we're starting out with the basics. So we're going to consider this entirely variable. Now I can do the math again on this. Take 2,450 times 40 pianos that we sold, and we should come up with that 98,000. Okay, but I need to identify all of my variable expenses. So I need to go back and consider whether this was fixed, okay, mixed, okay, variable, okay, or Okay, those are really my only 3 choices. So I'm going to go back in and I'm going to identify these so that you can see where they end up on the other side. Executive salaries were fixed because, again, the word per month. Insurance was fixed. Clerical expenses had a combination. So I'm going to use the term mixed. And then depreciation, again, was fixed. So what we want to do is we want to organize our costs by behavior. So I want to put all of my variable expenses here. If it's mixed, I'm going to have to break it up into its 2 components. Okay? So again, I'm going to try and highlight these so that we know what we're actually going to move over into the variable portion. So cost of goods sold, we said, was variable. We have the sales, salaries, and commissions. I am going to cheat and go through and use my equal sign to tell it to pick up the label. Okay? By doing that, I'm essentially pulling through the variable portion, which actually is only my commissions. Okay? So my commissions, remember, were going to be based on my sales times 0.08 or 8%. So sales salaries were really only $10,000. Okay, the other cost that we said that varied was going to be my delivery expenses, and that was 100% variable. So I could just pick up that whole dollar amount. Okay, the next thing I have, as I go through looking for my yellow, variable expenses was my clerical expenses, okay? So my clerical, again, I could have used the equal sign, it probably would have been quicker, would be to pick up the clerical expenses. Now, it is identified as mixed, so only $20 per piano is actually variable. So again, I'm going to do 20 times 40 pianos is going to be 800. Those were my only variable expenses. So I'm going to put a subtotal, total variable expenses. I want to add those up. So I have 110,000 of variable expenses. Now, if you recall, in the textbook we learned that variable expenses are, you can calculate contribution margin based on variable expenses. You take your sales and you subtract the variable expenses, and we end up with 15,000. That's how much is contributed to our profit from the sale of 40 pianos. We still have to cover all of our fixed costs in order to cover and come out either making a profit or breaking even. So again, I am going to just go through here and pick up my fixed costs. Sales salaries were $950 per month. That is the fixed portion. Utilities expense, I have $350. Depreciation is also fixed at $800. And I want to keep going. Okay, I want to pull up my executive salaries. I want to pull in my insurance. I want to take my clerical expenses, okay, and depreciation on my office equipment. The dollar amounts are going to equal here. Pull these through. Same. The clerical I need to adjust to 1,000. I want to add these together to come up with my total fixed. And for net operating income, I'm going to take my contribution margin, subtract my total. Okay, this is total fixed expenses, and this is my net operating income. And as I mentioned before, the two should equal, and they do. So essentially what we're doing is just reclassifying the traditional income into a contribution margin format.